Welcome everybody to episode 2 of our 10 series intensive crash course here at V2 Trading. Today we will be going over the basics and we'll teach you about actually trading and the basics of trading. So let's get straight into this episode. So to give a quick overview on what we'll be discussing today, we're going to discuss candlesticks. What are candlesticks? How to read candlesticks and the importance of candlesticks as well. We'll also be looking over the market mechanics, understanding how price moves, why price moves, and what is needed for price to move. That ties in with liquidity as well, where money is placed and how we can read that and use that to succeed as a trader. Finally, we'll be giving a quick overview and intro to our overall strategy here at V2 Trading. So let's dive straight into learning more about candlesticks. So let's talk about candles. And to understand how to use candles, you have to understand what candles are. So essentially, candles are the things we see on our TradingView charts, and they help us understand price action, and they honestly tell a story. Let me tell you how. First, you need to understand the overall anatomy of candlesticks. So I set up this chart exactly how you'd see in the charts I have set up too. The colors might be different, but you just have to understand that the left one is a bullish or going up candle, while this is a bearish or going down candle. So every single candle has a time frame, whether that be in a 4 hour, 2 hour, 1 hour, 5 minute. This candle essentially holds data in the time frame which you're holding. So for example, if you're in a 4 hour chart, that means that each one of these candles tell you data about 4 hour segments of time, which can really tell you a story. Candles, when a new candle is being made, there's something called a candle open. On a bullish candle, the candle open is the bottom of the candle, and on a bearish candle, the open is on the top of this candle that's actually filled in. And the wicks tell you about where the price has been during the lifespan of that candle. So I want to show you a real life example of this so you can understand a bit more. And I'll take you through an example of a bearish candle. And it will look something like this. We opened, we went up during its lifespan, as you can see by the wicks, and then we closed near the bottom. Let's go through an example right now. So as you see on MNQ, if you take a look at this candle right here, what do we notice? The candle opened right here, right? Because in a bearish candle, the top of the closed part is the open. This is the close because it's the bottom of the closed or shaded part as well. From this candle, we understand that price opened there, and in the 4 hour time span in which this candle was open, price went all the way up here, as demonstrated by this wick. And after that, we fell all the way down to even here. And then we pushed back up a little bit and closed here. How do we know that just looking at a simple line chart like that? We wouldn't know, right? So these candles truly tell a story. Now, let's take a look at a bullish example as well. Taking a look at this bullish example right here, in this bullish candle, we see that price opened at the bottom because price opens at the bottom of a bullish candle of the closed portion. And in the duration of this 5-minute candle, we went all the way down here. And then we pushed all the way back up until here and then closed a little bit below that. But this candle shows that sellers came in, but buyers held this overall level. This is a supply zone. You'll learn more about that later. But price came in to this level and sellers quit and pushed up, and price eventually closed here. To make it very simple to understand, every new candle opens like this, right? If the price is going down, we go down like this, right? Say we went all the way down like this and we closed here as well. This is a bearish candle. Why? Because we opened and we closed down. In a bullish candle, we open, price goes up or is bullish, and we close above. That's why the closes of the bullish and bearish candles are different and divergent. And the wicks can tell a story as well, as demonstrated by this and the bearish example which we showed earlier. Looking on these charts, I actually want to pull out this example as well. This is a nice bullish example as well. We saw sellers come in, and you see this big wick. This big wick demonstrates that sellers actually push the price down until here. So in this 5-minute candle, the candle would have actually looked something like this, where this is shaded in black. The candle would have looked like this when we were down here. But during the 5 minutes, we pushed all the way back up like that. And when we did that, we closed right there. This is a very bullish indicator. In price action terms, individuals call this the doji candle. Although I don't like looking at chart patterns and everything, this is a price action indicator which is heavily utilized to make smarter decisions. I don't like using chart patterns, but if you understand chart patterns in terms of price action, it could help. But in reality, chart patterns are just patterns on a chart, and without understanding the market sentiment, patterns will always fail. So, now that you understand a bit about candles, I want to emphasize you to open up your trading view, which you may or may not have set up with the premium version already. It's okay if you haven't set up the premium version. You can still practice on the delayed version or free version, and you can learn from there as well. I just want you to take some time to practice and look at the candles and try to understand what they mean and understand what type of story they create. And look through our different time frames as well, whether that be daily, a daily candle, or a 5-minute candle, or even a 1-hour candle. I just want you to practice because practice is very important. Let's take a look at the market mechanics now as well. You have to understand that the market moves on aggressiveness, not just if there's more buyers or if there's more sellers. I want to make this simple for you guys to understand through looking at a bookmap example as well. Let's take a look at our bookmap example right here. As you can see, ignore everything on the left hand side. We'll get into that in a later episode where we're actually looking over bookmap and how to read bookmap. I just want you to look at the right side. On the right side, we see all these orders, right? Think of the market like an auction. In order for price to move up, all these auction orders have to be sold. For every buyer, there must be a seller. Taking a look at this number, let's use a higher number for example. At 5605, there are 98 sell orders. These sell orders are not live orders. So imagine we're here. For price to go up to 5605, we need 98 sell orders to be bought up. So that technically means that we need 98 buy orders to move the price up to 5605. I hope that made it a bit more simple. But as you notice, there is a buyer for every seller. The market is an auction. It's not unlimited. You can't just continue to introduce new things. There is always a buyer for every seller, and it is very important to understand that. Think about it like this way. The market may want to push to certain prices because there are more auction volume there, because if there's not enough sellers who are looking to place your buy order won't be completely placed, and institutions know that. That's why they place big orders at areas where there are a lot more resting orders for you to be able to successfully fill your orders. It is important for you to understand that. So I hope you better understood how the market moves. The market needs a buyer for every seller. The market is auction, and the market moves on aggressiveness. On the DOM example, which I've showed you before, price needs aggressiveness in order to move the price up to that 5605 level, because sellers can keep on adding more and more orders, but it is the aggressive market orders or live orders which can push the price up and actually take away from those orders. If this is very confusing for you, I know I felt the same way when I just started as well. I highly encourage you to take some time to practice, and if it's still confusing, you can ask me any questions on the Discord or in the comment section below, and I'll try to answer these questions for you. Furthermore, take a look at some online trading basics websites or videos as well, because those can really help you out as they help me out as well. So let's dive furthermore into liquidity. Money is very important because the market needs money to move. And this ties in with how the market moves, as I mentioned before as well. Price needs money to move higher or lower. Institutions want to fill their orders at areas where there is a lot of resting orders or liquidity, which is essentially money, at a certain level. Because in that level, they're able to actually place their large orders. And if someone is trying to place a large order, they need a lot of supply in order to place that order. Think of it like real life as well. Think of a billionaire trying to buy 3,000 cars for supply. He cannot buy 3,000 cars when there's only 2,000 cars available. There needs to be 3,000 cars available for him to actually buy 3,000 cars. So what will he do? He will go to a dealership or supplier that actually has 3,000 cars and buy it there. Think of each different dealership like a different level on the charts. Institutions will always place their orders at these levels of liquidity, and price will move to these levels of liquidity if they're magnets rather than barriers. And I'll take you into the same example which I've mentioned to you prior to show you how a liquidity could either be a magnet or a barrier. So, looking at the same bookmap example before, taking a look at the right side, what do you think this would be? There's lots of liquidity resting in that area, and it's been resting there for a long time. This is going to be a magnet because there's so many orders that are resting. They're not looking to get rid of it every soon, right? They're not getting rid of it anytime soon. So institutions will be more likely to move price up there than something like there, because there, although there is liquidity there, it is very short-term liquidity, and if price comes down here, they don't know if the liquidity will be added once again or if it will get removed like at this level. You see how liquidity is getting removed instead of being added? While in this liquidity level above is staying steady above. You have to understand this in terms of institution. Some institutions may place orders or likely inject money into the markets in order to influence price to go upwards of here. The market typically moves in the direction of how institutions trade. So I want to emphasize that you want to trade with the institutions rather than against the institutions. So, higher time frame liquidity, or liquidity that is strong and stable, tends to act as magnets, while liquidity that is short term or kind of fluctuating or volatile, these tend to act as barriers. And when these barriers move up with price, that can be a very bullish indicator. So now that you understand liquidity, I want you to take this into practice as well. Go onto a bookmap live stream or more and just try using this information you have in unison with the information I gave you about the candles and also the information I gave you on how the market moves, in order for you to even potentially paper trade with this information I gave to you. If you truly understood what I told in just this episode itself, I believe you can take some great and profitable trades if you find a good entry model, which we'll get over in the next few episodes of our crash course. And let's give you an intro on what we'll be discussing in the next few episodes regarding our strategy. Essentially, the V2 strategy is a retracement strategy. We know that price will go up, especially if there's liquidity above, but we understand where price may want to go. That is for sure. And even then, we might not always be right. So we work with price action and we work with the current market while never being married to any bias. We use liquidity on Bookmap and the charts for analysis, but price action is truly key. We want to trade with the institutions, and if institutions are moving price closer and closer to liquidity, we want to find an area which is at good value for us to enter and continue the move up. Price never moves in a straight line up. It typically makes different waves and movements in order to move price up effectively. I'll give you a good example of this. So take a look at any place in this entire frame or any place over here. Market always moves in the same type of way. Market moves in waves. As you can see here, how is the market move? The market's moving up, down, up, down, up, down, up, down. But overall, price is working its way down, right? In this area, what is price doing? Price is moving up, down, up, down, up, down, up, down, up. What is price doing? Price is moving up. You can see this typically anywhere which you go, except for periods of market stability, which is called consolidation, where we're just stable at one level. These tend to be the shortest periods in the market, but there are decent trades that have been made there too, simply with liquidity analysis. But understanding that the market moves in waves can help you understand that you don't always have to enter down here to profit until you're there. You can enter in these retracements, which is in an uptrend. In an uptrend, a retracement is a period when we go down a little bit and then make our way back up. And in a downtrend, it's when we go up before making our way back down. So taking a look at this uptrend right here, a retracement could be right here. We saw price move up and we saw price go down a bit. This provided us with enough value for us to take price up to here, and maybe we take profit up there. We don't want to enter right at the lows. We want more confirmation, and a retracement can provide us a good entry for that more confirmation. And that's where V2 strategy comes in place. When you combine all this information together, all you need now are entry models and screen time and practice. Screen time is one of the most important things as a trader, because the more you look at the charts, the more you get used to it. The more practice you get, the better you will become. The more you adapt, the more you can be flexible with the market and actually succeed. Screen time is honestly essential because you start to understand how the market continues to move. That's why practicing and paper trading when the market is live is very essential. And I highly encourage you to start doing that after learning more in the crash course as well. I think that sums it up for episode 2 of the crash course. Today what we did was we understood overall candlesticks and price action and the overall importance of it. We understood the anatomy and how it can really tell a story about the market. And I highly emphasize you to practice this on the charts as well. We also looked over how the market moves and how the market is actually auctioned. And we gave you that car example, the car dealership example with a supplier and a billionaire. And you can take a look at this in terms of the market as well. I want you to practice both of those in unison as well. Additionally, we tied that in with the importance of liquidity or resting capital in the market. We need money for the market to move, and market can move towards money or move away from money, depending on the type of short-term or high-term liquidity, which we have discussed using our bookmap example as well. If you can practice these 3 things I've mentioned above in unison, I can almost guarantee you that if you have a decent entry model, no matter the strategy, you can succeed. This is one of the most essential things you need to know with trading, and that's why you need to understand this episode. In this entire crash course, I believe that this episode is one of the most critical because you need to know the basics in order to dive into more complex details. But understanding this simple ideology with enough screen time can make you successful. Finally, we also took a look into the V2 strategy, how we're trying to enter a price at a decent value to enter and follow the trend. We're never really trading against a trend unless we get into our reversal strategies. But typically, you're looking for a retracement to move with the trend and move with institutions. And that concludes this episode here today. I hope you guys take your time to practice a lot today, be that be backtesting or paper trading on TradingView. And I will see you guys tomorrow at the same time this episode was uploaded or premiered here today. Thank you so much for listening. I'll see you guys tomorrow. Keep practicing. Goodbye.